Hello and welcome to today's discussion on the implications of the Genius Act for corporate treasury teams. On July 18, 2025, the US government enacted the Guiding and Establishing National Innovation for US Stablecoins Act, also known as the Genius Act. This legislation marks a pivotal moment in defining how stablecoins and digital assets may integrate into corporate treasury and finance operations. Joining me today is Craig Jeffery, Managing Partner at Strategic Treasurer, a leading treasury consulting firm. He's here to help us unpack the implications of the Genius Act for corporate treasury. Craig, it's a pleasure having you with us today.
It's good to talk on this topic. Good to see you again, Push.
Craig, let's start broad. Why is the Genius Act an important topic for decision makers right now?
The Genius Act signifies an important framework, a usable framework for payment stablecoins. Before this, you've known how skeptical I've been of people using digital currency for regular payments and to what organizations would buy those. Very, very limited potential from the existing set of regulations, rules, oversight, or risks that exist. This provides a framework that addresses most of the key issues that a corporate treasurer would have. There's still some things that remain in terms of functionality and breadth, but it addresses the key areas of risk, compliance, who are the issuers, are they safe, are they backed, and so that it allows more focus on the development of the technology for making payments without necessarily routing them through a payment network. So these are US dollar based, but payments could be made anywhere in the world with this structure by using payment stablecoins.
Thanks for laying that out, Craig. Building on that, why does this legislation matter specifically to corporate treasury?
The legislation matters to corporate treasury for a couple reasons. The biggest one is now there's a framework that would allow a corporate treasury team to feel comfortable using this, maybe for making certain payments that might be in hard to use areas or adopting it for a broader use, particularly if the capability is built into some of their treasury or other payment systems. So the ability to make payments quickly, rapidly, and efficiently without necessarily going through your primary bank, without necessarily having to wait for a delay, but by being able to leverage some of the technology that's offered through the distributed ledger tech on a blockchain would allow for faster development, a richer experience. And this is the first time that there's been a framework where you wouldn't run away from here's what's being proposed to trade currency.
In your view, should corporate treasury teams consider adopting digital currencies, particularly stablecoins?
I would like you to ask me that question in about a year. I think this framework is significant enough that it should be on your radar of what's happening, what's developing. So this act has passed. It's not gone into effect yet, but they're setting up, some of the structure around that. There's quite a bit of regulation. There's quite a bit of writing that, in particular, law firms have done about the Genius Act. The fact that a number of law firms are writing about it isn't enough of a reason to keep up about it. But the fact that how the act has been formed, how it addresses most items that would be of concern to a treasurer and makes the development and the innovation that could come around digital assets, payment stablecoins, provides a much more positive view that the U.S. government and laws will support this type of innovation for trade. And so this one focuses on payment stablecoins, but there's certainly quite a lot of other digital assets. And so the framework and the laws that are coming out, the acts that are being put forth and they're becoming laws, are very supportive of the newer technology to do this while providing a stable and secure framework for that, at least stable from a asset-backed perspective and a regulatory compliance perspective.
So, Craig, this act includes some key safeguards. Which elements do you think could encourage corporates to adopt stablecoins, keeping the safeguards in mind?
Well, the top ones would be there's licensing requirements. So it's essentially organizations that can issue these stable coins have to be licensed and are treated like a financial institution or a bank. The second is the 100% backing by short-term liquid assets like U.S. currency, T-bills, items issued by the federal government or items that are treated as cash. The requirement and the inability for an issuer to depeg a stable coin. In other words, remove its connection with the value of a dollar. They can't do that. They can't have it be stable and then become unstable later. Those would be some of the biggest safeguards for why people would care about it. There's other activity about transparency, publishing what the holdings are for the asset backing of those currencies. That regular publication usually provides and engenders good confidence. Anti-money laundering, counter-terrorist financing, regulations, CFT, all of those are wrapped up in this. So because issuers are treated as financial institutions, the existing framework of some of those compliance activities get rolled up into it. Those are, I think, the biggest items that matter to a corporate treasurer.
Thank you for shedding light on those safeguards. What issues are not addressed by the Genius Act that Treasury departments should keep in mind as they explore stablecoin adoption?
This is pretty good because what items can be addressed by legislation or laws for something that's new? I think they've done a good job hitting the major points. My concern and advice to corporate treasurers and those system providers that may offer this is, one, you have to have adoption for it to work. You can't trade with just yourself, just like you can't have a phone if there's only one person with a phone, because you can't call anyone. I think those issues will be solved readily. I think the other piece is, how can you operationalize it? So what does that mean? You have to have the ability to make payments using blockchain, which means companies aren't going to create this on their own. They're going to use their treasury management systems, their payment hubs, their ERPs. That will have to be brought into those systems so that it is a feature that you can use to make those payments. That's probably the biggest and the core issue. Things like digital wallets, being able to enact those payments through the platform, just like you do payment runs. It could support traditional payment types, newer immediate payment types, could support payment types over the blockchain, like payment stablecoins. So if you have the ability to do it, and then you have trading partners, you have a good framework, that provides that whole basis that makes sense for organizations to adopt. So look for banks to support this, look for fintechs to support it, and then from the corporate treasury standpoint is pay attention to this, ask your vendors what they're doing on it with that, and that will help you determine if you can move forward on this and when. So it's going to be multiple years away before it's possibly used very heavily because it's law, but it hasn't gone into effect yet. There's a few things that are coming. So this is something to pay attention and watch, and ask your fintech partners, your consulting partners, and your banks, what are they thinking about it?
That's a thoughtful observation, Craig, particularly because it's critical for Treasury teams to be aware of what's not covered. So, Craig, can you give us a quick summary of what other legislation may be working its way up in the digital asset realm?
That's a good question. I'll be brief on this because this really relates to a broader topic that we need to go in more depth. There's two that stand out. One is the Anti-CBDC Surveillance State Act. Right now, that's the House 1919. It's not passed. It's not a law yet. And also the Clarity Act, which is HR 3633. This used to be known as the Digital Asset Market Clarity Act of 2025. Now it's called the Clarity Act. Just briefly, the Anti-CBDC Surveillance State Act is against central bank digital currency surveillance state act. So the focus here is to prevent the U.S. central bank or the Federal Reserve, from issuing a CBDC where they can use it to what's stated as weaponize a digital dollar to erode our freedoms, basically to see all the transactions that people have. So this is a preventative approach with those type of guidelines. So I think that diminishes what can come about from a CDBC or CBDC, central bank digital currency, but it's meant to provide those type of protections. So now if you're on that, if a central bank digital currency, a US CBDC, gets created, it won't be tracking all of your spend back and forth. You can remember a few years ago when it's like all transactions over a certain amount were going to be reported. There was quite a hullabaloo, quite an uprising against that. It's like, why do you get to see all our transactions, right? There's already reporting for over other amounts. So that's one aspect. There's a lot more to that that's still working its way through as of this time of recording. And Push, the other one is the Clarity Act. This is to provide a regulatory framework that would allow digital assets to work. Some of those things are necessary, a necessary precondition for digital assets to be used at scale. So you can always do an individual one, but if you're going to trade, you need the type of framework that lets it work. So digital assets are beyond just payment stablecoins. There's a whole host of other ones. I know I keep mentioning digital commercial paper, but there's a whole host of other assets that can be traded on the blockchain that can cause rapid settlement, effective settlement, that's not just point to point or through a particular bank. It would allow for a broader array. So these are useful to keep track of what's going on. There's certainly a pretty solid push for providing frameworks that allow for the development and the innovation around digital assets. And so these are two other ones that are in process. The Genius Act is already a law. It's not in effect yet, but it's a law.
So you mentioned the anti-CBDC legislation. There are countries around the world that are working for both a B2B and a B2C CBDC. With the Genius Act now signed into law, do you think this shows the door to CBDC because you have stable coins which can come into the system for corporations? There are organizations like Amazon and Walmart already working to adopt it.
I don't think it shuts the door, but I think it diminishes the opportunity for an extremely effective central bank digital currency because there'll be so much innovation. It doesn't shut the door. The Fed could certainly do it, but restricting the area that most people or many people are troubled by, I don't know what the statistics are, but if you use a digital currency to monitor individuals and their financial transactions through this digital currency, now everything's going through one place. You can see it all now. As if there was a question about your or my transactions, there has to be a reason. Okay, here's a reason we have to do search. The bank has to turn the information over because there's something that's suspect. The authors of this act, the ones that are co-sponsoring it, are saying, no, that can't be the standard case, that it's automatically visible. It's not anti-CBDC, it's anti-CBD surveillance. But if there's a very effective stablecoin process going, I think it diminishes the urgency or the need for a CBDC. But I could be wrong on that. There's a lot of different opinions on it. But to me, it's if you have something that works very well, you might go with one of the early movers rather than wait for a central bank digital currency.
Craig, I really appreciate you sharing your thoughts and analysis on the Genius Act and its impact on corporate treasury. It's been wonderful having you here in person. And to our audience, a big thank you for joining us today for this insightful conversation. If you found today's discussion valuable, please subscribe, share, and stay tuned for more content focused on treasury and payments. Until next time, stay sharp and stay connected.